So on the side of companies, if you have a good project, it's always a good time to raise capital, right? You just need to ensure that the capital you raise is appropriate. So in other words, if you have a view that based on your own internal sense, the advice that you've gleaned from those on whom you rely as a business person, if you think that the interest rate environment will be transitory, if you believe that we'll have higher rates for a while and then things will moderate, which is a viewpoint that is held, right? Then don't fund the business with fixed rate 15-year debt. It wouldn't make sense for you to lock in at this quote-unquote high interest rate because you think rates are going to go down for 15 years. It just doesn't make sense.
Hold on, you said something a while ago that I want us to go back to. If you have a good business and a good project, it's always a good time to raise capital.
For sure. For sure. Right? It makes sense.
Yeah, let's tag that. We're going to tag that.
This is the Barita Podcast, which is a medium for information purposes only. This podcast is not a recommendation to buy or sell any securities. This isn't a research report, nor intended to serve as a basis for making any investment decisions. Contact a licensed investment advisor before making any financial decisions. Let's get into the Barita Podcast.
Welcome to another episode of the Barita Podcast. You can see prior episodes at barita.com/podcast. All right, so we have Ramon Small-Ferguson with us today. Ramon, thanks for joining us.
Thank you very much for having me. How are you doing?
Yeah, man, I'm all right. So I think it's the first time we have you on camera as EVP, right? So I'm not well late, but congratulations.
Thanks, Ral. I appreciate it.
Yeah, so I mean, we want to touch on a couple of things today, right? But I mean, we can start there in terms of the role as executive vice president. How are you seeing the firm? What are you focused on? Et cetera, et cetera. Set the frame at a high level for us.
Yeah, no problem. So, I mean, in my role, new role, I have oversight for the executives that oversee, I guess, the key revenue generating areas of the business, and we are an investment bank. So we're cut across a couple of different areas, right? So the sales and trading and treasury function, that function reports into me. The investment banking and corporate finance function also reports into me. So capital raising for customers, that sort of thing. The asset management division that I used to have explicit oversight for, now the executive in charge of the asset management division reports into me, and that's really dealing with management of client funds and pursuing alpha in that respect. The alternative investments division, which spans real estate, private credit, private equity, also reports into me. And importantly, the glue that holds everything together, the investment strategy and research division, also falls under my oversight. So my job, how I see it, is really clearing roadblocks to allow all those guys very able to perform their function, advising and kind of looking at the entire business holistically to include the interest of our clients and kind of position Barita to perform as best as possible, both in its capacity as a fiduciary and in fulfilling the goals of our clients, and in dealing with our own affairs, which really center around revenue generation and creating shareholder value. So that's really it in terms of the scope of the role.
Okay. So, I mean, in summary, you are responsible for everything.
Not at all. It feels like that on some days, but no, I mean, I am a cog in the wheel. Trying to function. Yeah.
All right, but it's good. So, I mean, in terms of revenue generation, front facing, the kind of tip of the spear stuff. Yeah. That's what we're looking at. All right. Yeah. Well, I mean, that gets pretty interesting, and it's an interesting time.
Trust me,
to take that really.
It is a very interesting time, very unprecedented. I've been in the business for a while, and I tell people that I've been through a few successive crises, I guess you can call it, if that's a word. But everyone is different, and we're now in the midst of one that feels very different than the other quote-unquote shocks that we've seen before. It seems like a more prolonged shock, right? Yeah. So maybe not as extreme as some of the ones that we have seen in the recent past, but it certainly feels like it's going to go on a bit longer than those, for sure.
Yeah, I mean, Ramon, how you feel? Because we're coming out at a time where interest rates were rock bottom. Jamaica is at 0.5%. Money easy. You know, people can raise capital. The environment was friendly to that. And then boom, them gave the roll. And 13 times increase in the interest rates. I have pandemic residue. And boom, a war.
I mean, I tell you, it feels like a setup, right? But it isn't. I mean, I tell those that I have had the privilege of leading. I mean, from the very beginning, I've told them that, listen, these turbulent times is when you really show your worth in the marketplace, right? This is really why we get paid and, you know, by our customers to really guide them through these difficult times. And this is when the expertise comes out. Very interesting time to take over, but not daunted at all. And it had to happen, right? Rates were low for some time. And really, central banks around the world were almost reading from the same hymn sheet for a very long time. It created a whole bunch of liquidity all over the world. And, you know, very low interest rates were the order of the day. Now we're in a time where rates are going up. Liquidity is tighter, to say the least, right? And liquidity is tighter. So we really just have to manage, really read the tea leaves as best as we can and try and create crystal balls or brush them off in some respect and try and see our way through this time. Yeah,
I mean, it kind of feels like, you know, like you said, it had to happen, but boy, is like the money might try and make up for all of the past sins in like a quarter.
I mean, so it's interesting, right? If you think about the dilemma that the Fed has been going through under different leaders, the 2008 crisis led to really a raft of unprecedented measures by the Fed and other central banks followed, right? I mean, quantitative easing in and of itself was a phenomenon. We're going to study that maybe for decades, if economics is relevant decades from now. I hope so. So it led them down a path that saw the central bank continuing to layer on support for the economy, and by extension, I guess financial markets would have benefited, right? There's a strong correlation there. So if you recall in 2014, I think the Fed tried to achieve a little bit of liftoff. If I remember, at least that was the sentiment.
They signaled it.
They did, and it was not well accepted. Exactly. So we saw the taper tantrum, and then they actually lifted up a bit, I think in late 2015, and that was it. You know, one issue after the other led to easy money, easy policy. COVID came and we saw them bring out the unprecedented toolkit once again, and fiscal policy was in lockstep in really trying to support the fallout, support the economy rather, to be resilient in the face of the fallout of the pandemic. And now they're at a stage where they really seemingly needed to get some lift off, you know, and they have the perfect excuse, a whole lot of inflation. So it's really putting them in a position where they have monetary policy capacity to fight the next quote unquote war on the economy, although we do have a literal war going on. So it's understandable why we are where we are, albeit it has been painful in some quarters for sure.
Yeah, I mean, so it's just to frame up the context, you know, we hear interest rates referred to as kind of like gravity for capital markets. Others refer to it as like a hurdle rate, right? So just for viewers, we were at 0.5%, a record low for some time in Jamaica, for instance, and now we're at 6.5, right? So that's 13 times higher. So, you know, if we think about financial markets as a race, you know, with a hurdle, it's at 0.5, but no, it's you know, you're at 1 foot, you're at 13 feet now, you know, we're not scaling that. So that's the context. And we spoke about it last night at the event a little bit. It is a challenging context, right? So what participants are interested to find out and hear from you and hear from us is in terms of raising capital, which you know is one of the things we're in the business of doing from a public market point of view and from a private market point of view. How do you see the environment and what are the nuances to achieving that?
So that's a good question. So, I mean, for the better part of the recent past, right, if we were to look back maybe 3 decades, Jamaica has a fairly diverse experience as it relates to interest rates, right? I mean, we had very high interest rates in the 90s, and for the better part of the 2000s, rates were elevated. I guess the turning point was our latest engagement with the International Monetary Fund, which was very successful, right? So, I mean, post 2013, we had the National Debt Exchange, we kind of reset interest rates, and we set about a coordinated effort across both monetary and fiscal policy to really fix some of the structural issues that we had in our economy, right? So we have seen debt trend down, even in the face of challenges. We've seen the fiscal accounts move much closer to being optimally where you want to be from an emerging market country perspective. I mean, we've moved past balance and now we're actually seeing surpluses in some areas.
Imagine that.
Which is unimaginable. Our monetary policy framework has become a lot more sophisticated, very deliberate, very coordinated, very data-driven. We're certainly seeing a lot of learnings coming out in terms of how our central bank is managing things. And we have moved to inflation targeting. And what we're seeing in terms of the central bank response to where things are is mirroring that. Right? They are sticking to the script and they're really executing on their commitment in terms of being the safeguard against price volatility as evidenced by inflation. Now, I mean, people are split as it relates to the how and the what, and I won't debate that here. I'm here to talk about the capital markets and, you know, the state of things and how I see things going forward. So the capital markets have really flourished in the face of everything that I just described in terms of the progress, right? One major driver of that, other than low interest rates, which is definitely a friend to the capital markets, has been the reduction in the crowding out effect, so to speak, as we describe it, that was happening with the government of Jamaica.
Government is not as hungry for debt.
Correct.
Okay.
So there's a lot of dominance in terms of the government of Jamaica being a serial issuer in the market, raising capital to fund its accounts. Because of everything that I just described, that has not been the case for the last 10 years. So people like you and I have been able to go out there and do our jobs and convince companies to not focus as much on bank debt for certain projects, right? Because there's a big space and big room for bank debt, and I'll get into that in a moment. And actually utilize the capital markets, the flexibility that capital markets offers to be better in their own respects, right, to grow their businesses, right? So we've seen a flurry of initial and other public offerings. We've seen a flurry of landmark transactions in terms of size, complexity. We've seen a lot of startups come to the fore and do well, and it has really just generally augured well for progression and sophistication in our capital markets. It's been a very good time to be involved in the business that we're in, for sure. I've, experienced a lot for the first time. It's been very interesting. And importantly, a lot of economic growth and job creation has really come out of this period in Jamaica's history, right? So now we're facing a bit of a headwind, right? Rates have gone up, and not only have they gone up, but they've gone up over what feels like a very short period of time.
Because it is.
So, I mean, I was having this discussion
last
with
Christmas
someone.
We're at 0.5, right?
That is probably true. I think liftoff started maybe in the last quarter of last year. I don't think it was quite December. But I was having this discussion with someone where I was talking to a client, maybe September last year. They were contemplating a project, and the project required several third-party approvals. So they had the concept. I mean, it's a going concern business, so issued them an indicative term sheet. I think the rate was maybe 7% secured structure. And they're like, okay, thank you. This looks good. My accountant has run the numbers. I'm going to take this away, go and get my approvals, scope the project fully, and come back to you guys when I'm done. Well, it came back to me late in the summer, and of course, that 7 has gone to heaven. It's no longer with us.
Yeah.
We had to reissue new terms, which were in double digits, which is where the market is now. And the client has been thinking about it for the last couple of months. I haven't gotten that update in the recent past, but it's really indicative of the impact, I suppose, of higher rates on capital markets participants, at least on the side of the issuer. Right? People can get spooked. It may be a situation where the higher cost of funding now makes the project a little bit more marginal. It's our job, though, as investment bankers, to read the market context and ensure that we're doing right by both issuers and investors. Right? So we have to balance. We have to ensure that we price risk properly. We have to ensure that we structure to not set our customers up in terms of companies to not be able to afford the liabilities that they're taking on. And we also have to take out our advisory hat at this point in time and ensure that we're not pursuing transactional business, right? We're pursuing relationship-oriented business. So it may be that we tell our client, boy, I would love for you to do this transaction in this quarter. It would be great for me. But we probably need to wait 6 months and see how things turn out. Right? See, rates kind of stabilize a bit. Then I can go to the market and try and raise this $3 billion for you. Right? That being said, there is still appetite in the market for funding, and there's still appetite in the market for investments, right? Despite the higher interest rate environment, deals are clearing. So it's really a case-by-case basis in terms of how to approach things. So high interest rate environment, people are a little uncertain, and uncertainty is the definition of risk, right? So I guess heightened risk environment. But where there is risk, there is sometimes reward on the back of it. So it's about finding that little crevice where we need to occupy.
Yeah, I think it might be a Chinese proverb or something. It's like there are two sides to the risk equation. Danger and opportunity.
Well, right? There you go. So it's about leading everybody to the side of opportunity and avoiding the danger at all costs.
Absolutely, right? Absolutely. So where does that leave us now? I mean, for your typical client, IPOs are not overnight things, not short run. A lot of people have IPOs in their strategic plans, 3-5 years.
Yes.
Right? So for the people that are coming down to the completion of that arc, you have to make a decision. Say, all right, I'm there now. I've done all this work over the last 3-5 years. Is this a good time to come to the public market?
So another good question, right? So, I mean, I'm going to answer it in a very roundabout way and probably cycle through the options that a company has generally, but also with the nuances around this environment, right? So, broadly, companies have the option of going to either private or public markets for funding, right? And they generally have the option along a spectrum of going for debt funding on one end of that spectrum and equity funding on the other end of that spectrum, and some stuff in between, right, which I'll get into. So to describe generally the options available in private markets on the debt side, I kind of segment them in 3 segments at this point in time. There is the bank market, which everybody's familiar with, which has been the main staple in Jamaica for a long time. And that still represents I think probably the largest single source of typical funding in businesses here in Jamaica, right? But banks have a particular frame in which they love to lend, and understandably so. They are funding these loans with depositors' money, which is generally unsecured, generally seen as low risk. So they have a responsibility to ensure that they're lending products similarly match up with the risk that people are taking by depositing money with them, right? So their structures tend to be secured for corporates. I mean, very mature blue chip corporates get larger unsecured funding structures based on their balance sheet, cash flows, profit and loss, etc., their financial statements and the strength thereto, but generally secured. Right, so collateral is a must in some cases when you go into the bank. Right, they generally have a frame within which payments are made. So it may be monthly payments of both paying back the principal of the loan and interest over time. And they generally have tenures that they can go up to 5 years, 7 years, 10 years, depending on the nature of the loan. So they have a whole Rubik's Cube of solutions, but they're set out in set frames.
Yes.
Not a lot of wiggle room there, right? Which is where us in the capital markets come in to kind of fit into the space that the banks really don't occupy, right? So we have to be flexible, we have to be creative, right? So that's the bank market. I'd say the second market that I can mention is the private capital markets. So there is debt funding available there, right? And banks tend to do bilateral facilities where it's you and the bank, right? So they're lending to you. Or they can form a syndicate where a couple of banks come together depending on the size of your transaction. If you're, it's a whale of a transaction, it may take a couple of banks to take it down. The capital markets effectively allow for an expansion of that effect. Because if you go to the private capital markets, I can assemble a bunch of appropriate investors to fund a transaction that gives you a lot more flexibility than a bank loan, right? So let me give you an example. I can line up 20 investors. These investors could be pension funds, insurance companies, securities dealers, high net worth individuals, who will come together and fund your transaction. So it's a diversified source and pool of people, right? So that's one advantage. On the side of the actual instrument that funds your business, you get a lot more flexibility. So maybe monthly payments don't work for you because of the nature of your business. We can maybe move to quarterly payments, semi-annually, maybe even once a year, depending on what the appetite of the investors are. Maybe paying back principal before the end doesn't really work for you based on the nature of your business. No worries, we can maybe set up a facility that has what's called a bullet payment at the end, right? Which is something that maybe a bank cannot do routinely, right? Maybe we have investors who have appetite for your unsecured debt. Maybe the banks may be limited in terms of the amount of unsecured debt they can do. No worries, our investor pool can take that up, which adds another layer of flexibility. So there are a number of moving parts that we can tweak through the private capital markets. There is still, as the name suggests, privacy around it. You can do it quietly. We don't need to alert your competitors that you are raising $2 or $3 billion to come and take over the marketplace, right? We can have quiet whispers with investors that we know well and keep it private, and you can go ahead and execute in silence. So the private capital markets, I guess, are the second lane down which companies can travel, right? And that naturally creates investment opportunities for those for whom it's suitable, right? Because it's important. These things are not for everybody, at least in their raw form, right? And the third lane are alternative lenders, right? And we've seen a number of those pop up, right? Who offer what we call private credit instruments, which again tend to be bilateral or syndicated in nature, just like the bank. So they have elements of both the bank and private capital markets. But they tend to have even more flexibility than what is typically available in the private capital markets. These instruments tend to be designed to the T for the company or customer in question, right? So let's say a customer is pursuing a business opportunity where in the early years, the cash flow will be low, right? We could maybe design an instrument, an alternative lender, or an investment bank who tends to sometimes play the role of either the alternative lender themselves or an advisor to the alternative lender. An investment bank can design a solution that sees very low coupon payments in the first 2 years or very low interest rates in the first 2 years, and then it kind of steps up to a higher rate. It could be an instrument that gives regard to the fact that, as you said, the company has an IPO in their strategic plan in 3 years. So the instrument might start out as a debt instrument, but it may say we can convert this debt to equity if the company goes to IPO. Right? And there are a whole lot of levers that can be pulled to really sync the instrument up with the needs of the customer via the private credit lane, right? So those are kind of the 3 lanes in the private debt markets that are available to customers in this environment, right? Still a lot of options.
Yeah.
Right?
On that last note,
Yes.
Interest rates are high, as we've been saying. Is there an option where, the environment is what it is, you have to pay a high rate, but can that adjust down in the future years?
That's also perspective. So you can set. So that's a very good point. You can actually reward customers. So customers will come in and say, listen, guys, I'm going to be the next big thing. All right. Believe in me, I have 10% market share now, but if you lend me this money, I will move that 10% to 40% in 3 years. Right? Or whatever indicator, I'll move my profits from 2 million a year to 40 million a year.
Yeah.
So you can build in automatic step downs into the company's performance. So you may say to them, all right, I hear you. If you meet your targets, your rate will move down by 1% or whatever it is per year, because naturally their business is getting better, their credit is improving, and you can reward them for that. So as I said, there are a myriad of features that you can build into these instruments because of the nature of how they're negotiated, as I said, typically bilaterally or via syndicate. And these lenders tend not to be bound to the same strictures of the bank. Their funding is different. They aren't funded by deposits. So they can take a bit more risk, albeit controlled risk and risk that they understand and mitigate for in different ways than the bank can. So that's really, I guess, a discussion around the range of options that exist on that side. So on the equity side of things.
Before we get to equity, tell me if I'm summing up correctly in terms of the private credit and the credit generally, right? So the biggest pool traditionally in Jamaica is bank loans, but those come in kind of a preset packages and have some amount of rigidity.
That's correct.
Right? And then the nature of their funding, deposit funding, the man on the street, retail, etc., gives them a heightened fiduciary responsibility. So they're shy with the risk.
That's correct.
Then you have the capital markets. The capital markets offer a wider range of investors and potentially wider pools.
Yes.
In terms of single ticket sizes.
Yes.
And then you can do that quietly, like you said, and the structures are a bit more flexible.
Correct.
Right. So you're not necessarily slapping one rate, one payment. You can push off the principal a little, so you have wiggle room. The alternative lenders introduce even more flexibility and tailoring to the transaction. So
that's correct.
So if you believe in your company and you're looking for a financing solution that is going to evolve with your company and really not give a cookie cutter solution, but something that is suited to your specific evolution and business cycle,
yes,
you might want to go that way.
That is correct.
That's a fair sum up.
That is a very good summary.
All right. So tell us about the equity markets now.
So on the equity side of things, right, and I'll start with the private markets again, and then I'm going to deal with the public markets more generally and talk about the Jamaica case, right? So on the equity side, you tend to see a couple of different kinds of equity in private companies, right? There's what we call founders equity, which is first set of guys to the table, right? They are, as the name suggests, guys who start the business, and they're the insiders.
Yes.
They come and take the first risk with the business and get it off the ground, right? Get it going. And that tends to go in first, and that tends to have a different feel to it, right? Because it's a startup business. It can go south. Most businesses actually fail. So you can appreciate that the risk associated with founders equity is substantially different than any other equity that comes into the business at any other time into the future, right? And founders are therefore at times treated differently from shareholders who come in later in the day, right? Because of course they were there from the start. And typically as the business evolves and grows, founders have to put more money into the business, right? And they tend to do so via mechanism, which is, I guess, fairly well known to people who focus on public markets via, say, rights issues, right? And in doing so, they give very little regard to price and value, right? They tend to just agree amongst themselves to put additional money into their business that they started at some agreed price, right, or rate, $1.50. That tends to be the approach. Right? Now, founders' equity is sacred, and then you tend to have first or second round equity, which comes in from a third party, right? And again, this is private. So, typical third party or first or second round equity investors tend to be, I guess, among the similar pool of people who participate either in the capital markets or are on the private lending side of the debt spectrum, right? So it tends to be capital market participants who are looking for private equity opportunities and specialized private equity firms or investment banks who tend to make these types of investments, right? And typically a prerequisite to the investment is going to be a valuation, right? Yes. There has to be some arm's length exchange, because now it's no longer the people who started the business. It's no longer the founders, right? The men and women who built the business from scratch and took that startup.
They almost live and breathe the business.
Correct.
Right.
It's now a third party.
Yeah.
I mean, and this third party, of course, is still taking a risk. The business may still be in an early stage, but there's something there built already. So you need to pay a market for it, right? It's just like any other investment, right? There is a price to be paid. So the typical prerequisite for, say, someone like us, an investment bank looking to come in as an outsider into a business that has been funded by founders, is a valuation and a proposal that we put to them around a level at which we'd be willing to invest. Some people come with their desired level at this, and we have commissioned a third party valuation and we believe that we're worth X, and if you're going to buy 10%, then you need to pay Y. So it's typical and very different from when they're injecting additional money into their business, right? So it almost mirrors something that we know and have seen very often in the public markets, which is the difference between a rights issue type transaction and a follow-on issue, or as we refer to it here in Jamaica, and it has taken hold in the region, an additional public offering of shares.
APO.
Right, exactly. So rights issues take on a couple of forms, right? Rights issues are usually renounceable or non-renounceable, right? So renounceable rights issues are available exclusively in the initial instance to existing shareholders of the business, right? And that's what rights issues are about generally, allowing existing shareholders in a business to inject additional capital in the business. Now, the nuance with a renounceable rights issue is that those existing shareholders, should they choose not to take up all their rights or invest all the money that they're entitled to invest in the business, they can actually assign that right by renouncing it to somebody else, anybody else, right? Now, some renounceable rights issues are limited to allowing renouncing only to existing shareholders, right? Only people who fit the bill, right? While others allow renouncing to anyone else, right? Non-renounceable rights issues, as the name suggests, basically say, listen, if you're not taking this thing up, it's going to go into a pool, and the other existing shareholders are going to compete in that pool to try and take it up. We're not letting anybody else into our company.
Yes.
So even public companies have done that. Right?
Yeah.
So to use the example, say, of Barita did both forms of rights issues, I remember, in 2019. So in March 2019, Barita would have done a non-renounceable rights issue where shares were offered at $15.50. And I remember at the time, the market price was, I think, maybe in the high 30s, 40s, may have even been in the 50s, and I forget my numbers. I was in the midst of that at that time of putting the final touches on deciding to come to Barita. Yeah. Right? So I was looking on the outside, looking in like, wow, I wish I was a Barita shareholder. Right? I could get access to shares at $15.50.
Yeah.
And later in the year, Barita did another rights issue, this time renounceable, which allowed external parties to come into the business, right? And the approach was a little different. So the $15.50 discount was steep at that time. Yeah. But when Barita did the renounceable rights issue, which allowed other people to come into the business, I recall the price was maybe $45, and the trading price at that time was in the 50s. So still a discount, but a much more modest discount, which is typical, much closer to market price in terms of where the shares were valued for outsiders coming into the business. And similarly, we've done 2 additional public offerings since then at $52 a share and then $80 a share. And in both instances, these were done at slight discounts to where the market was trading at different points in time, whether when it was decided or when it was made public,
but nothing
or
like
whatever
the original rights issue.
Nothing like that steep discount. So it's kind of a similar case in private companies when founders are looking to put additional money into their business at some decided rate that they've agreed amongst themselves, and when they're letting outsiders into the business, right? So those are the funding options available, right? So during this time when interest rates are high, money is short, I'm sure founders may be thinking, is this the time for me to look to a partner to come into my business, right? And Barita can help in a couple of ways, right? One, if you already have a partner in mind, no worries. We can advise you. So we can come in, they may have an idea around the valuation of your business. We can give you an idea of what we think the valuation is. We have experts internally who have a whole lot of experience in valuing companies, public and private. And we can also advise you around what's best transaction structure. If your potential suitor requires funding, we might be able to give them a funding solution. So there are several ways that we can help you, even if you have someone at the table already, right? To complement that, we could be the person at the table, right? We are interested in providing funding and investing solutions to our clients across the spectrum, whether it's equity, debt, or somewhere in between. So we could be that potential suitor to help you with the additional equity capital that you need in your business to maybe access that bank loan that you've been negotiating for a while to get that project off the ground, right? We operate across the capital stack. We work well with other funders and lenders, and we don't need, as they say, the whole hog to be comfortable as your financial advisor. We fit in where we add most value, and if we can't add the value, then that's fine. We'll probably point you in the direction of where you can go to get what you need in your business. So those are kind of the 2 ways that we can help, either as advisor or potential suitor to invest in your business. And in both cases, we'll be looking at what's the market value of this business to determine where either ourselves or the potential investor will come into the business.
So, that was a lot, but on the last point of the APO and the rights issue, it's kind of a topic du jour or whatever in the marketplace. Is it fair to brand an APO is this, or rights issues is that? Is it fair to automatically view one as better than the other, or is it better to view it through the lens of the age, stage, or what the company is trying to accomplish?
So it's a good question, right? And there are a couple of considerations, and I've kind of seen the public debate, right? So financial markets generally are driven by a couple of factors, right? There are fundamental factors, how well is the company doing, and how well is the industry doing, and all these things. Is the management fantastic? There are technical factors. You'll see people. You turn on CNBC or Bloomberg, and the layman will see a guy drawing some lines all over a chart and saying this thing went here and that, and it will bounce and all of this. Right? I won't get technical.
Yeah.
Or you might go on social media and see somebody trading foreign exchange, and they have their chart up and they're telling you what direction things are going to go in because of what has happened in the past. So those are technical factors. And then you have sentiment, investor sentiment, consumer sentiment. That's the human element of things, and it's very important. Right? We can't ignore it. You could have the best thing in the world, right? If it does not align well with the sentiment in the room or at the point in time when you're pitching it, it won't work. Right? And it's the same way with the markets. For a long time, companies in our markets delivered year after year after year in terms of profits, and difficult times in Jamaica. And they traded at very low single-digit price to earnings ratios, which is usually indicative of stocks being very cheap.
Yeah.
But sometime in, I suppose, the early part of the last decade, in 2012, 2013, when the economy started to do better and rates started to go down, and we started to see outsiders investing in our market and buying companies for multiples of what they were trading at, sentiment changed. And suddenly people realized, hey, this might actually be cheap.
Yeah,
right? So sentiment is a very important determinant of how markets move, and particularly in smaller markets where people tend to be in touch and tend to row the boat in the same direction. Typically, sentiment can be a big driver. So what I'd say is, while the fundamentals may align well around what a rights issue does and what an APO does, typically it introduces additional capital into a company. Right, and as long as that capital is put to good use for the benefit of the shareholders, it should be positive for the shareholders. The fundamentals align well. There are factors around sentiment that may determine whether a company does well if they do a rights issue versus an APO. I mean, if everyone feels like APOs are good and rights issues are not, then there may be factors affecting things. There also may be what you call externalities, right? When you do statistics, and I won't get too technical, they tell you correlation does not necessarily lead to causation, meaning not because two things seem to move in the same direction, it means that one causes the other, right? It may be spurious, as they say, it may be unconnected, right? So it may be a situation where coincidentally, one company does a rights issue and things work out well, and another company does an APO, and over the horizon things have not worked out well. But generally speaking, my own view is, while there are obviously a lot of short-term opportunities in the market, they tend to be fleeting. They tend to, and stock market is a zero-sum game, right? So typically, those who win in the short term, there are people who lose in the short term as a result, right? But what works almost all the time is a longer term focus, investing strategy that really doesn't tie much to, is this company doing an APO or a rights issue, and focuses more on the factors that tend to transcend different periods of time in the economy or in the market, or even transcend sentiment, which is the fundamentals. Is the management good? Is the business strategy good? Is the company poised to grow over time? Right? So I really won't comment on whether one is better than the other. It really boils down ultimately, in my view, to what the funds are used to do in the company in terms of transforming the business, and what the business strategy ultimately ends up being.
And in the end, the value that you add to the shareholders.
That is correct. That's correct. So, that's principally important.
I mean, regardless of how you raise it. So, takeaway is time, right?
Yes.
So we look at the market. We look at like the JSC. Main index has struggled.
Yeah.
Junior index has done significantly better.
Yes,
right?
It has a whole lot of volumes traded as well.
Combined index struggle. US dollar index too, significantly better. So where does that leave us? Is it fair to say it's a good time for smaller companies to come to the public markets?
Good question.
If you have another massive company like a Massey, you are them wait. Like where does this leave?
So it's a good question. So it's nuanced and it's case by case, but I'll give some general advice. So on the side of companies, if you have a good project, it's always a good time to raise capital, right? You just need to ensure that the capital you raise is appropriate. So in other words, if you have a view that based on your own internal sense, the advice that you've gleaned from those on whom you rely as a business person, if you think that the interest rate environment will be transitory, if you believe that we'll have higher rates for a while and then things will moderate, which is a viewpoint that is held, right? Then don't fund the business with fixed rate 15-year debt. It wouldn't make sense for you to lock in at this quote-unquote high interest rate because you think rates are going to go down for 15 years. It just doesn't make sense.
Hold on, you said something a while ago that I want us to go back to. If you have a good business and a good project, it's always a good time to raise capital.
For sure.
Right.
For sure. Right? It makes sense.
Yeah, let's tag that. We're going to tag that. Right? That's an important point.
So that's number one, right? You have to raise appropriate funding based on your outlook on the general environment. But more importantly than that, you have to raise appropriate funding for the type of project that you're looking to do or the age and stage of your business. You can't be looking to raise higher interest rate debt that demands payments every month or every quarter or whatever the case is, knowing that you're going to be pursuing a business strategy that is going to come to some sense of maturity over the next 3 years, right? You'd be setting yourself up to fail. You would still have a good business or a good project, but bad funding, right? So I've described a wide spectrum and array of funding opportunities that may be available to you. You can go to the bank, you can look at the private capital markets, you can look for an alternative lender who can give you something bespoke and customized. You can look at putting money in your own business, betting on yourself if you have it. You can look at bringing in a third party into the business, and there is this negative connotation associated with bringing investors into your business. I mean, there have been horror stories. Right? But what I would say
they've been great stories as well.
There have been fantastic stories. And it's important to bring in the right person and ensure that there is alignment, things are professional, you get the right protections, you have your legal representation, because together, and we've seen the benefits of partnership, right? I mean, since the beginning of time, we've been collaborating as human beings. We have formed packs and groups and done the impossible. We've built pyramids and developed incredible technology.
Yes.
So sometimes going it alone is not the best thing to do. So there are a wide array of opportunities, even in this environment, to raise money that's appropriate to fund your business. And there are still many opportunities that can be pursued despite the uncertainty and the difficulties in the operating environment. So still a good time, I'd say, provided you have a good business and
a good project.
Or a good project.
All right. So, I mean, if we shift and like look a little bit at private markets, I mean, we mentioned it, interest rates are high, the environment isn't what it was, right? But then Mr. Ramon raised $4 billion for a financial company, right? So the question is, does that mean that is a good time to raise money in the private markets as opposed to
the public markets.
To the public markets. If I need another 4 billion, do I call Ramon? Is that how it works?
So again, it's nuanced once more, and you asked some version of this before. So if we look at what has happened in the public markets year to date, it would imply that there isn't really a whole lot of appetite for large transactions. And I know a number of people have been kind of waiting on the sidelines, see? Because the fact is that during uncertain times, people are hesitant to commit large portions of their portfolio. They want to see whether they can hold out and get better prices. So, yes, I mean, if you have a large public equity transaction to do, for example, it may make sense to kind of wait and see, canvass the market a bit, see what the interest is like, as appropriate, of course, in the context of the regulatory framework that governs these types of activities. That's a very important underpinning to what I'm saying. And the strike when the iron gets at least warm, if not hot, right? If you have a smaller transaction to do, as you have said, the sentiment towards these smaller junior market transactions has been very strong year to date. So it seems to imply that the runway is clear for these types of transactions. Right? In the private markets, it really is nuanced. It comes down to the capabilities of the institution that you're in touch with. It comes down to the relationships that they have and their ability to distribute the whatever transaction that they're arranging on your behalf and the time over which they can do it, because things are changing fast. If you raise money in August, then the price would have been different probably than what you can get in November. So you need an institution that has the architecture that's set up to be able to raise that money and move it around quickly enough in terms of the product and get the funding to you quickly enough as well. So we think as an organization, we've built ourselves in a way via a couple of avenues, which I'll get into, that position us well to be the investment banking partner of choice, even during these difficult times. One, we spent the first 3 years of the post-acquisition period of Barita, once Cornerstone took over, building a firm foundation, a firm financial foundation. We raised over $33.5 billion in equity capital because we knew that markets would get tumultuous. And equity, more than anything else in a business, sure, it's the medium via which you can take advantage of opportunities, but it's what safeguards your business during difficult times. It's a buffer, as they say. So we enhanced our buffer significantly in the first 3 years of our post-acquisition period. We also endowed the business with a good bit of human capital, right? So we pride ourselves on having a very strong team on the investment banking side. Raul, you know, that's a big part of what you do. We have Therese Kettle, who is our head of investment banking, leading the capital raising efforts for companies. She has completed a number of landmark transactions on behalf of companies here. Largest cross-listing on the JSE, largest fundraise by a junior market company. The list goes on. Largest additional public offering here in Jamaica. Goes on and on and on in terms of the landmark transactions that Therese has been able to do. During, by the way, a very difficult period. I'll tell you something. Therese joined this company maybe 7 days before we had our first COVID case here in Jamaica. So she has been operating exclusively in a post-COVID environment and still managing to help companies create value for their shareholders and their stakeholders, their employees, create jobs. That's ultimately what we do in terms of what we enable in terms of our funding. So the financial base that we've been able to build helps us to be capable in terms of completing these transactions. The human capital that we have brought into the business that has been working hard on behalf of our clients helps us to execute. And we also think that we are not constrained, save and except, of course, one, our regulatory responsibilities, two, any fiduciary responsibilities we have to our clients, and both those two things never tend to be in conflict. And three, the risk parameters that have been set out by our board and that are measured and monitored and safeguarded by our risk management unit, of course, but also every single officer in this company.
Yes.
Save and accept those limitations. We are very creative thinkers, right? There is sometimes a negative association with creativity and anything to do with money.
Yeah.
So don't be afraid. There is the backstop of all the 3 safeguards that I've mentioned before, right? But we try to think outside of the box to ensure that the solutions that we provide on either side of our business, whether it's to our investors or to our clients who are seeking to raise money, those solutions benefit from all the brain power that every single team member on that side of the business has built up over the extent of their career. So we try to think outside of the box to make things work. And that's, I think, the third thing. Outside of the money that we've raised that makes us capable and our people, we as an organization try to innovate. The group's mission and guiding principle is to continuously challenge the status quo. And that's what we're about on behalf of our clients. So.
Okay. Sounds good. I mean, so at the top you were mentioning your responsibilities in terms of revenue, but I mean, by given the fact that you have treasury responsibilities, there's quite a bit of balance sheet there as well, right? So the question for you that I know the marketplace is interested in, and where you sit now. So you gave the history of Barita, you know, building those buffers, raising all that capital, $33.5 billion. And then at the end of the day, you know, we've said it on this in this platform before. You put numbers on that to really make it stark. I think the company has been at double what the industry has averaged in terms of capital adequacy, and well over 4 times the regulatory minimum. So when you say you add buffers, it's not
it's not an understatement. It's not an understatement. And I mean, during this time is when that has really come to bear. All right. So one, raising equity is very difficult, and we raised a lot of our equity post the onset of the pandemic. It was hard. Right. But 2, raising equity, while it does not have an explicit cost, it's expensive because you have to give a return on that equity. And in this environment, it may be more challenging than if it were 2 or 3 years ago, right? But we took
over time is significantly more expensive than debt, right?
Correct. So we took the hard decision to do that because we knew that there was going to come a point in time when the economy, having benefited from all the stimulus, years and years and years, we would kind of feel a little fatigued. Right? I'm sure we're all feeling the fatigue of the economy right now. And a fatigued economy does not augur well for financial markets. So what have we seen year to date? I mean, you spoke about the unremarkable performance of the main market and the combined market here. But what has also been the case is that US and other developed markets in terms of equities have also been down year to date.
The weird thing is bond markets have lost more than the equity markets.
Correct. So higher interest rates have also seen debt markets, whether you are a developed market like the US, the UK and parts of Europe, or an emerging market like Jamaica, Dominican Republic, Bahamas. You have seen sharp fall off in bond prices. I mean, government of Jamaica debt securities, which have been, a star in emerging market bond investment portfolios for the last, I want to say for the entire post-IMF era, almost the last 10 years. You have seen the longest bond that we have, which is a bond that matures in 2045. I think we maybe started the year at a price of 140 on that bond. At points in time this year, we have seen that bond trade close to 100, which is over 30%. Now, that sounds like a lot, but it sounds like a lot when you contextualize it in the context of it being a bond, a debt instrument, which typically, prices fluctuate, but 4% down, 3% up. So all of us locally in the financial services sector tend to invest in securities, it's equities, bonds, etc. And as a result, we would have faced a lot of losses associated with holding these positions, right? Our general strategy at Barita, I mean, we've spoken about this publicly. Sure, we invest in traditional assets. We are big players in the bond market. We're big players in the equity market. We are a broker with the JSE. We're the second largest broker for the last 2 calendar years, up from, I think, 6th before the company was acquired. So we're a big player in the space, but we have generally limited a lot of our exposure to market risk, even though we have a lot of tolerance for it because we have a large capital base. So as markets have tumbled, it has impacted generally the results of financial services firms, and we're seeing it in terms of the releases on the JSE. It has impacted our results too. I mean, we certainly haven't made as much money as we could have if market conditions were different for our shareholders. But importantly, even after all of the turmoil of markets coming down as they have over the course of the last several months, we still have a very safe business. Our capital ratios are still very high. We still have ample levels of liquidity. We're still very capable to serve our clients who need us to use some balance sheet to help them with whatever solution they have. And we're still able to provide solutions for our investors who want to participate in Barita, whether it's via repo or whatever the case is, a structured note. We can use our balance sheet to do that. So the hard yards that we would have done in raising all of this equity to fortify the business and make a very capable business, it has also served to make a very resilient business. So we expect that this fatigue in the economy may be prolonged, and by prolonged I mean it certainly, we don't anticipate a snapback like what we saw with the pandemic, where it felt like things were, at least in the financial markets, it felt like things were bad for 1 quarter and there was a quick bounce back. We expect this fatigue to last for a little while, but importantly, we believe we've built a business that can outlast the fatigue, right? Which is an important point for our shareholders and stakeholders, people who invest with us. We still have a very safe business, even with all the turmoil that's happening in sections of the market.
And I mean, it's there for everybody to see with financial statements, right?
It is. It's evidenced by all our public releases, and we continue to be heavily regulated and scrutinized. And it is the nature of the business that you're in. But there's a lot of trust that our customers put in us. But we can assure them that there's a lot of verification that's done on their behalf on the back end to support their trust
as well.
Yes.
So I mean, give some insight into like the strategic direction and future, looking at the short history of Barita under Cornerstone. A lot has happened.
Yes.
Right. A lot of capital has been raised, and then why, and so you kind of laid out the defensive strategies in terms of fortifying the business. Business is safe and so on, and can deal with volatility and uncertainty going forward. A little bit of the offensive thing, can help clients with balance sheet where necessary and allow clients to participate in growth of Barita. But all of that capital, what are you doing with it? No, we see, look like you go buy a parish.
Oh boy, not at all.
Not quite, but we saw large purchases there, right? So there's that. I mean, you can talk about a little about that if you want.
Yeah, so I can reiterate a lot of what we've said publicly already, right? Which is a couple of things. One, post-acquisition, we wanted to build a full-service investment bank. So there was a missing piece. The corporate finance piece was not as developed as it needed to be. So we established an investment banking division with the focused objective of being capable to raise capital on behalf of businesses. And since the inception of that business, as I mentioned before, it has done very well for our clients and for the organization, and therefore our shareholders. Right? So we've built out a full service business. We have built out our wealth management capabilities, right? So we have a premium wealth and corporate solutions division, which is headed by Sansia Thompson. and located at 60 Knutsford Boulevard in the Panjam building, right? So we have that division to serve our clients, our high net worth clients exclusively via that service. Our retail division, we have expanded our branch network by one so far. Right? We have another location in Montego Bay, and the retail segment is headed by Dave Dixon, who really has oversight for the branch network. And what we've done is essentially enhance our ability to serve our customers. We've really spent a lot of time on customer experience. We are infusing technology into our customer interactions to enhance efficiency and just make the customer experience generally much more pleasant for both sides, right? And further on the business side, we have spoken a lot about our bias as it relates to our principal investment strategy towards alternative investments. Right? So, of course, as I mentioned before, we are players in traditional securities, but we have built out significantly allocations to alternative assets. Based on our last earnings release and our public disclosures, we indicated that financial year to date, we've deployed over $5.5 billion to private credit / private equity type investments, and that has actually featured in our earnings for our last financial year, right? Those types of exposures which have been resilient in the face of these rising interest rates, right? So important, the effects of diversification are shining through. We have also curated, organized, and funded a portfolio of what we think are some prime real estate assets, which we have, as we telegraphed before, made available for access by the public through our real estate unit trust fund. And we have now set out on a strategy that will see us ultimately attempting to extract highest and best use from those real estate assets. Again, that's an asset class that we think has great significance in terms of overall economic growth, and also offers great diversification to traditional asset classes, right? So I spoke about private equity, credit, and the role that we've been playing there, and real estate. And we also have our eyes on infrastructure, which is a longer tailed type investment, right? These things tend to, one, take some time to get out of the ground, and two, have very long lives. But we do have a pipeline as it relates to that side of things, and that rounds out the spectrum of alternative investments that we've been focused on. So that's another area of our strategy that we've been very public and open about. And generally speaking, Raul, I mean, again, overarchingly, we're here to challenge the status quo, right? We are doing, most of what we're doing is not unremarkably in a global context at all. We're simply helping to move the needle with respect to our local capital markets, close to where global capital markets have been for years. And we believe there is great value to be had for our customers on both sides of the business, whether it's investors or people looking to raise capital, and ultimately, quite honestly, for our economy here in Jamaica, that will ultimately benefit from additional jobs and economic growth and value being created out of the real sector impacts of the investments that we are either making or helping others to make, or designing, or whatever the case may be, whatever role we're playing in that respect.
I got you. So, I mean, you talk about long tail and long-lived assets, and when you mention infrastructure, and I'm wondering, because I'm looking and I'm saying, somebody to raise a lot of equity, a long-term asset, right? I think the first APO was around 45 or 52 or yes, whatever the offer was, but we see those participants, looking forward. It's what, 2 years now, not that long, right? But over time, we see value accruing to those early participants, right?
Yes.
In the equity, we see value accruing now to long time investors in a real estate fund, right? Is that a theme in terms of these arcs where for the long-term investor.
For sure.
Staying with Barita and journeying on the strategy.
Yeah, for sure. I mean, for us, staying the course is important.
Yeah.
Right? We're big proponents of staying invested, serial investing, right? Being committed to a long-term investment strategy. And of course, that strategy may tilt and pivot over time under advice. But we think the path to true wealth creation for the majority of us in this country, right, is through a committed and consistent investment plan of whatever size. It could be $5,000 a month or $10,000 a month.
We saw what $10,000 a month can do last night.
Well, there you go in the initial instance, right? But that's what I think is the path. So, I mean, not everyone has the capital to be able to buy a fantastic piece of land and develop it into 10 stories of apartments. I mean, that's one path to wealth. But how easily accessible is that to the common man?
Or maybe you can buy into the Barita real estate fund and then it can do it for you, right?
It can do it for you. So our job is to really create opportunities for the common man to, via his own way, through his investment plan, create a consistent and sustained way to affect the future for either himself or the generation after him or whatever the case is. And I believe if more of the population can be galvanized around this approach, right, can be brought in and drawn in and have some affinity towards staying the course and serial investing, I believe the next generation will look very different than the one that we have today. Right, just plain and straight. So that's our mission, right? Curating these investment opportunities and making them accessible to the common man. I mean, we're the people's broker. This is a business that Mrs. Humphreys Lewin built 45 years ago this year to make investing accessible to the regular guy, and we have stuck with that. So sure, we're doing alternative investments and we've built out this investment bank and we have a wealth and corporate solutions division, but we have a large part of our business that's still committed to meeting the common man where he lives and helping him to transform the lives of himself and those to whom he is committed, right? He or she are committed, right? So that's what wakes me up in the morning. So I mean, I told you about all the areas of responsibility, but that's what really drives me to
that's if I don't text you before the crack of dawn.
Right, well, yes, that is true, right? But yeah, man, I mean, that's what really pushes me, because that's the mission that we have been on, and I believe we've really moved the needle, but there's a lot more work to do. Right? There are a lot of Jamaicans that are not invested, and I want to find them and get them invested.
and change that, right?
I need to go out on the road.
Yeah, man, for sure. But I mean, so that's nice. But speaking about that, right? Speaking about that, Jamaican stories, you know, we like to tell a little bit of Jamaican stories, and I mean, since we have you here, right, Ramon, you, if we think about your story and where you've come, right? You weren't born like in a castle, with like a path laid out to success for you, was it, right?
Not at all. So I started in St. Thomas. Well, I was actually born in Kingston and spent the first 4 years of my life in Portmore.
Really?
Yes, I remember some of it, but the fun memories really started in St. Thomas. I went to Portmore Primary and Junior High School, as it was at the time. Left there, went to Mark Bay High School, which has produced a number of very well recognized persons in society today. I'm very proud of my primary and high school. So interestingly, Hansel Parchment, Olympian, he and I were in the same year at school. Dion Jackson Miller, famed journalist, she's also a Martin Bay High School alum. So there are a number of us around. All right. And I left high school, went to St. George's College for a year, for sixth form. I was too young to go to university, so I had to do something to pass the time. And thankfully, George's accepted me. But I only stayed there for a year. I went to the University of Technology, Jamaica, where I fell in love with finance. Right. I always knew I wanted to do business. Well, at least after I got to a certain point in high school, although I still ended up doing a lot of science for whatever reason. I'm sure it has helped me here. And at University of Technology, I really had a fantastic experience learning across the board about finance, risk management, corporate finance, securities trading, lending. It was a really comprehensive program. I left school feeling very prepared for the work world. And it really did give me a soft landing. So I thankfully got a job right in my field, started as an investment analyst with the Jamaica National Group, moved to become an assistant PM portfolio manager, where I was managing a prop portfolio of equities and fixed income in 4 different markets, structured notes. It was very interesting stuff, I must tell you. And from there, became a portfolio manager, had broader responsibilities in the group, got to manage insurance company portfolios, that sort of thing. And then I moved over to the investment bank within the group, where I was chief investment strategist, head of research, helped to build out the investment research function there, and added some sophistication to, or additional sophistication to, the operations there. So, I mean, a lot of what we have done at Barita over the last couple of years is not unfamiliar to me. I have done some version of that elsewhere before, and it after about 6 or 7 years, I left the Jamaica National Group to join Barita.
And here we are.
And here we are. It's been almost 4 years of very interesting stuff. I mean, I tell people that over the last 4 years, I have done or experienced or been a part of so many things for the first time. It's been an excellent learning experience. And as I mentioned, the mission that we're on is one that really resonates with me, really affecting change in the lives of the average Jamaican and Caribbean person is something that really, as I said, gets me up pumped out of bed in the morning and puts me to bed feeling comfortable and good at night. So, we're here to do a lot more in that respect over the coming years.
Okay, so that's an amazing arc, right? And a very Jamaican story.
Yes, right? I agree.
Right? Kingston to Portmore to Morant Bay, right? The question, like, if you could give some advice,
yes,
to a fourth farmer, a third farmer watching the show, right?
Yes.
Again, a very Jamaican youngster, right? First of all, there are success stories. You're not destined to mediocrity or malaise or failure just because you're Jamaican. You don't have to go overseas to try and give yourself a chance.
Agreed.
So, you sitting here, living and breathing that as a reality, right?
Yeah.
What would be your advice, or what inspired you? What really drove you to really change your situation? Because, by the way, you weren't living it up in Morant Bay.
No.
I don't think.
By no means at all. So what I'd say is a couple of things that have worked for me, right? And everybody's situation is different. There is really no silver bullet, right?
And that's an important thing for people to understand, right?
Yeah, I always tell people that there are many different paths to success. So I don't take exceptions and make them the rule at all, right? You always hear an argument, for example, that school is a waste of time because look at the number of people who have dropped out of school and have done very well for themselves, right? They are billionaires. Well, there are a very small number of billionaires, and I suspect the vast majority of them, have something that's not related to the fact that they didn't go to school. That helped them along the way and set their path. And so I don't make exceptions into rules, but a couple of things worked for me. One, in terms of motivation, I really drew a lot of motivation from my mother, who was very prominent in shaping me into the person that I am. So that really helped me a lot. Some people may not have a similar kind of beacon, but I did. It really led me to where I am. That's one. And two, what was reinforced to me was the importance and value of education, right? So at different points in time during school, I was never the sharpest person in the class or top of the class or whatever it is. But what was consistent and what I knew was that education was a bridge via which I could get from place to place, right? So, I did well enough in GSAT, so I went to the school that I wanted to go to, and I did well enough in CXCs, so I was able to go to business, even with the threes that I got, which were not important ultimately. And I did well enough in university, which was the ship that sailed me to the first job, right? I was able to do well enough in the interview. I retained enough. I read enough before the interview. And I have used my education to affect change in my life. It has been my currency of social and other mobility, and it has allowed me to help others who now in some instances depend on me. So, one is finding your beacon, whatever that is. So it might not be a parent, it may be something else. You have to find something that leads you forward. And you have to recognize that your present situation is not what you're destined to, right? You can actually affect tangible change in your life. And two is to find what that bridge or carousel is going to be that's going to carry you to where you are. Education was mine. I used that to move from strength to strength. Even as it related to my career, I decided to be very strategic and seek out the foremost respected areas of study in my field to try and pursue them, and it worked out. So it helped to move me from place to place, I think, in terms of the learnings that I would have garnered, and I guess whatever respect I would have garnered from having done those areas of study. So that has been it for me. It could be something else for you, but the point is there is something. There is something that you can look to motivate you, and there are things that you can do to change your circumstances. The key is to stay focused on what is motivating you and stay consistent with the things that you need to do to move the needle. So that's what I would say in a very general way and in a nutshell.
All right. So, it sounds good. It sounds good, and it is very inspiring, Ramon, right? And
thank you.
Yeah, man. And I'm glad that you could share. We've said a lot. Is there anything else in terms of Barita or capital markets, or you have a closing message?
Yeah, I do. So again, and I've said it before, now is the time, guys, when you have to rely on us who are professionals in this space. No, I'm encouraging everybody. It's your money, it's important. In the same way that if you go to a doctor and you get an unfortunate diagnosis, the next step is to get a second opinion. I encourage you to consume diverse views as it relates to what's going on in the current environment. So, as much as I think Barita has some of the best and brightest in the space, it's top quality in terms of what you can avail yourself of. I'm not telling you to exclusively rely on us, right? You can, but I think you should consume diverse views, right? So that's the first thing that I'd say, right? So rely on us, but consume diverse views about what's going on. The second thing I'd say is now is not a time to panic, right? It may represent a time of opportunity because you're not investing for today or tomorrow. You're investing for the future. And one thing that has been as sure as the sun rising in the morning is that economies go through cycles, and every bust tends to be followed in over varying periods of time. It could be a 2-year span, a 1-year span, 6 months. We saw what happened in COVID. Every bust tends to be followed by a boom. And if you remain invested long enough, you will benefit from a boom or 2 or 3, depending on when you're alive. So to reiterate, the best path to creating wealth is to being consistent and staying invested over periods of time. And that has worked time and time again. So as I say, if it's not broken, don't fix it. Right? So I encourage everyone to come into Barita Investments Limited. We have advisors that are just waiting to see if we can affect positive change in your life. That's our job, right? So we're here for you, and we're here to help to make your money work for you.
Wonderful. So stay invested, keep investing, eh?
Yeah.
All right, Ramon. Thank you so much.
Thanks, Raul. It's always a pleasure.
Yeah, man. Thank you. Blessings.
You've just listened to an episode of the Barita Podcast. The Barita Podcast is available on all Barita's social media platforms. If you'd like to invest with Barita Investments Limited, visit our website at barita.com or contact us at 876-926-2681 to get started.